Hey guys, it's Rick and Mike from Heirloom Wealth Management. Quick hits. Right now we're going to be talking about what the heck is a fractional share. Is it different than a whole share? And stock splits, both 2-to-1 and 1-to-2. So when we talk about owning a share of a company, okay, it's been popular, it's been economized, democratized to the point where, you know, if you have a $3,000 stock, you want to get in the stock market, you can't afford the whole $3,000, but you still want that stock, you can actually buy a partial share. You are still getting the same amount of ownership. If they pay a dividend, you're just going to get the fraction part that you own of that dividend, or fraction of the ownership. So if you own 1/8 of a stock, they even allow you to do that. You're going to get 1/8 of that whole stock, but you're getting the same return. It's going to be a much smaller slice of the pie, if that makes sense. I mean, I don't think there's a better way to explain that. You're still able to own it. It just democratizes an easier way for less money to get into. You know, Amazon's trading, like 130 something today. You only have $20. You can still buy Amazon with a fractional share. It's also a reason that you might find stocks splitting or kind of coming back into themselves. So, Mike, explain splitting, and does that have any fundamental? Is that a good thing, bad thing, or a non-issue?
No, it's like when you think about a stock split, there's two ways that it can go. Typically, where you'll see a stock split is one share becomes a very large value or price. Alphabet, recently Amazon, the shares got over $2,000 per share. To your point, there's smaller investors that's prohibitively expensive. They can't buy a $2,000 share because it's too much money per share. So what they'll do is they'll do a stock split, and it's basically like it's a non-factor from an investment standpoint. The business doesn't change, the investment doesn't change. I like to think about it as, when you get a pizza, do you want 8 slices or 4 slices? It's the same pizza. It's the same amount of pizza, it's just how you're splitting it. So in that instance, they'll do maybe a 2-for-1 stock split. You owned 1 share before, now you own 2. It was $1,000, now it's $500. Same amount if you add them together. Typically, stock splits, though, tend to be followed by positive news or positive price appreciation anyway. Reverse stock splits are the opposite. And where you frequently see this is where a company's stock price goes very low. If it's what's commonly described as a penny stock, trading below $1, they'll do a reverse stock split. So you have the opposite happen. To get the value up, instead of 1 share, you get 0.3 share or 0.25 shares. It's just worth more. In essence, this is different ways to split the same pie. It's not having a material impact on the profits that you're going to receive or why you would or would not invest in the company. It's just for those reasons I described, something that will happen. Typically, when a stock price gets very high or very low. Yeah.
Subscribe below. So you see when we have updates come out, and we will talk to you soon. Hey guys, if you like that, click here or here to see other videos that we've recorded, and we'll see you soon.